All right, how's everyone doing today? Today we're going to tackle parent company accounting. All right, and all that means is when a company purchases another company, there's a specific method, or actually there are three specific methods for handling the accounting for that, and we're going to go through those three very specific methods. So let me go ahead and pull up my resources now and get started. All right, so I've come up with a scenario. And everything here is written by me, so there are certain things that are just for examples. All right, these are just demonstration basis, so there's no need to go looking too much into it. The goal of this video is to teach you how to handle the mechanical process of parent company accounting for its subsidiaries. All right, so the scenario, a company called Parent is purchasing four subsidiaries for $1 million. All right. So that is the scenario, and we're going to ignore valuation. If the company is purchasing under 20% of the equity value, this is called a passive investment. So if a company comes in and says, we want to purchase under 20% of your company, that is called a passive investment. And what is used to record that going forward is called the cost method. And if a company comes in and says, hey, we want to purchase somewhere between 20 to 50% of your company, that's called an active investment, and that is recorded using the equity method. Now, if the company comes in and purchases 50% or more, that is called a controlling investment, and that is recorded using the consolidation method. Now, what I'm going to do in these next steps is to just show you how each of these methods work. Remember, again, this is just a mechanical process of showing you how this works in the accounting world. This is called parent company accounting for subsidiaries. All right. So here we go. The first one we're going to look at is the cost method. All right. So this is the balance sheet. Now, be cognizant that financial statements include the balance sheet, the profit and loss statement, otherwise known as the income statement, and also cash flow statement. But right now, I'm just showing you the balance sheet of each of these processes because that's where most of the activity happens. When we get to consolidation, I'll talk a little bit more about what else happens on the income statement or P&L, and we'll discuss that in short detail. But again, this is just a brief video to get you acclimated or familiar with parent company accounting. Anyway, so this is what the balance sheet would look like prior to your entries. Um, Pretty straightforward. You have your assets, you have your liability, and you have your equity. Now let's look at what it would look like. This is the cost method. Please remember this is the cost method. All right. Now this is what it would look like after. All right. So remember the cost method under 20%. It was purchased for $1 million, and as you can see, the journal entry process shows the debit to equity investments and the credit to investments in subs. Right down below, I tell you where on the balance sheet it shows up. Your assets is debited and your equity is credited with the cost method. And all, as you can see, is the parent company. That's the only one that will be debited and credited in this case to reflect the cost method. And I'm just trying to think of if there's anything else that I need to explain. Some of the nomenclature you might see on the balance sheet, instead of equity investments, you may see investment in XYZ, investment in 1, 2, 3, 4, things of that nature. The investments in subs and equity is pretty standard, but this is the cost method. All right. Now let's move on to the equity method. All right, so this is the equity method. As you can already tell, you can see the 4 subsidiaries right here over to the right. And there's a reason for that. We're going to need that information to process the equity method. So this is what it looks like before. And now let me pull up the after. There it is. And the reason we needed those balances, the journal entry that's processed totals your equity from each and every subsidiary to show your investment in those subsidiaries. All right. So subsidiary 1 had equity of 300,000. Subsidiary 2 had equity of 500,000. Subsidiary 3 had equity of 400,000, and subsidiary 4 had equity of 100,000, totaling 1.3 million. And that's what you see showing up as your equity investments and your investments in subs. That's how you get that number. All right. If you look over to the right, you'll see the corresponding equity in each and every subsidiary. And again, the parent company will be standalone. You will record this on the parent company, and the parent company will be standalone, and the subsidiaries will do their accounting on their own. All right. The only time you consolidate is when you have 50% or more. And remember, with the equity method, that's when the company has only purchased 20 to 50% of the organization, and that reflects an active investment. All right. So now the equity method is the consolidation method. I'm sorry, the consolidation method. There's a similar approach, but there's an additional step that needs to be taken. Now let's move on to the consolidation method. All right. So this is what a consolidated balance sheet looks like. You have you have your parent company and your subsidiaries side by side. And at the end of the row to the right, you total each and every account. As you can see, that's what the worksheet does. It totals every single account, all the way from the parent company to subsidiary 1, subsidiary 2, subsidiary 3, subsidiary 4. So that's how you consolidate financial statements. Normally, as I mentioned earlier, you'd see the P&L or the income statement, because that too has to be consolidated. And now it's worth mentioning that the elimination is necessary for intercompany sales, right? So when you consolidate, you want to get rid of anything that will be doubling up, or something that's not an arm's length transaction, right? Because if you sell between parent company and subsidiary 3, accounting says that you need to eliminate the transactions between those companies, so that it's not it reflects that it's not an arm's length transaction, that it's an internal transaction, right? Because what would happen is companies can balloon their sales, and it won't be reflective of the true nature of business. Because you can say, I sold $1 million worth of goods to my subsidiary, and if that shows up in your sales, and those sales are only worth 20,000, that's misrepresentative of your financial statements. So in the accounting world, when you sell to your own companies, you're required to eliminate that when you use the consolidation method. Anyway, so let's move on to what it looks like after you have officially closed the books and consolidated everything. So as I mentioned, similar to the equity method, you sum up the subsidiary equities, you put it on the parent company's books, 1.3 million, 1.3 million in your equity investments, and 1.3 million in your investments in subs. Again, I notated that the debit goes to the asset, the credit goes to equity. But what's unique here is the elimination of 1.3 million, because basically what you have here is you're taking the equity of the subsidiaries and you're putting it on the parent company's books. So that 1.3 million is going to double up if you don't eliminate it, right? I hope that makes perfect sense, because if you total going all the way across, and then you actually take a number from summarizing the subsidiary equity, and you put it on one of the books, 1.3 million is going to be doubling up. So you have to, it's called a one line elimination that takes place in every consolidation. All right, and I've highlighted where updates are necessary through each of the slides. so you know what was done and what changed. All right. So I tried to do a good job of itemizing and reflecting what happens. And as I said, when you consolidate, the only additional thing you have to remember is if there are intercompany transactions, those two need to be eliminated. I didn't build any of those into this exercise because that would have been being a little, that would include a little extra detail. And I wanted this to be as basic as possible, as I said, to show the mechanics of how you do parent company accounting. So hopefully that was straightforward. We covered the cost method, the equity method, and the consolidation method. And we talked about why you would need to use each of those methods. Um, and that's because of the percentage investment that a parent company has in its subsidiary. All right. So hopefully that's straightforward. Most accountants would grasp it pretty easily. These videos are made for accountants and non-accountants alike. So I want it to be as easy as possible. So if you have any questions, if anything is unclear, please be sure to ask them, and I'll go ahead and try to answer them via text communication or via video. All right. Thank you once again for viewing. I'm Janor Lewis. This is my channel. Have a great day.